I wish like when I was an entrepreneur, I would have known about this a little bit more so I could have invested passively, because once I sold my business, I didn't have any other income coming in, right? That was my business. So I had to start something new.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the show. Today, my guest is Chad Zdenek from CSQ Properties. Chad is a rocket scientist, an entrepreneur, and now he is into multifamily real estate and syndications, including self-storage units. Chad, welcome to the show.
Sounds good. Thanks for having me on, Gabe. I appreciate it.
You know, I wasn't kidding. Chad really is or was a rocket scientist. Chad, tell us a little bit more about your experience with, I believe you worked on the space shuttle, correct?
Yeah, that's right. So I guess technically a retired rocket scientist, but yeah, I did that for 7 years working for Boeing and Rocketdyne. I was a structural dynamics engineer on the space shuttle main engines, working with the turbo pumps. And I started really young. I actually got hired when I was 21, a youngest guy by far on the team, but was able to work with some incredibly brilliant people, worked with NASA a lot. And it was an incredible experience, but I was always an entrepreneur at heart. So I ended up leaving there to go start a small business with my brother, but it was fun. Rocket science was no joke.
So Chad, I can totally relate to the idea of being an entrepreneur at heart. I think everybody dreams about starting their business now and then, right? I mean, that's an idea that pops into everyone's mind. But I mean, it sounds like you had the dream job, right? You graduated from college as an engineer. Here you are working on the space shuttle. It's a dream career. How did you know that, you know what, maybe there's something else out there other than this amazing career?
Yeah, so I'd always been an entrepreneur. My dad is actually an eye doctor, but he ran his own practice, so that was very entrepreneurial. I think that's where I kind of got my roots from, and it was always a part of me. But having the opportunity to work for Boeing and working on the space shuttle main engines, I was like an amazing opportunity. And I was also, while working full time, I was able to get my master's in structural engineering and my MBA. From USC and from UCLA, and they paid for both those degrees. So it was an amazing opportunity. And they had me on the executive management track, so I was doing really well. But then when I was getting my MBA at UCLA, get this, there was 1 year when me and both my brothers were at UCLA at the same time, and they were both playing football at UCLA. I was getting my MBA. And then when my brother had actually at his 6th year, he had a few classes to take the last quarter of that 6th year, the first quarter of that 6th year, and he started a lighting business, doing Christmas lighting for friends and family. And that was the first year of my MBA, which was a 3-year program. And so I used that business as kind of my pet project, if you will, within entrepreneurial studies, because that's what I was focusing on. And really just helping him to grow that business. It was him, my sister, and a couple workers, and just basically hanging lights for some friends. And started out, very, very humble beginnings. And we didn't even get my parents' garage. We got the attic in the garage was where we started from. So, but we grew the business, and at some point, pretty early on, he wanted me to come over and work with him, full time. And it was really tough. I was doing really well with Boeing. I was going to different space flight centers for NASA, presenting pretty regularly to NASA. I was a team lead for my projects, and it was going really well. But my brother really wanted me to come work with him and grow the business more. And so we made a deal. I said, look, okay, you get the business to a certain level, and I'll leave Boeing, and we'll do a Christmas lighting company and see what happens. And sure enough, he got it to that level. And right after I graduated from UCLA, I left Boeing, and I was ridiculed by a bunch of colleagues, how can you go do this and blah, blah, blah. And rightfully so, it was definitely pretty risky. And I wound up taking a 50% pay cut to go work with my brother. And my brother wound up paying me more than he was paying himself. So just like the ultimate compromise, he wound up giving me 50% of the business, and we grew it. And then finally, by the time I left about 15 years later, we had grown it to about 75 employees, 3 different warehouses. We were the largest company in LA doing Christmas lighting, wedding lighting, event lighting, and built it up to be a really good sized company. And then I eventually sold the company, or my half, to him. He still runs it today, and I went into real estate full time as an investor and syndicator, which we can talk about a little bit later. So it was quite the journey.
Yeah, so I definitely want to get into the real estate side of it. But before we go there, so a little bit more on this lighting business. Was it more product based or service based?
All service. Well, 95% service.
So I'm guessing if you say like you guys did weddings and Christmas, let's say weddings, somebody said, okay, I'm doing a wedding, then you would show up, you would have all these spotlights and other decorative lights, you would set everything up. They would pay you for it at the end of the performance or the end of the ceremony. You would take everything down and bring it back to a warehouse, that kind of thing.
Exactly. But we did like big projects. So like Universal Studios, their entire holiday lighting program we did for them. We did the LA zoo lights that they had. We did the city of Beverly Hills, the Forum, the Greek Theater, and then any celebrity mansion house that you can think of. We did those properties as well. So it was a lot of really large properties, big projects, a ton of work in a small amount of time. But yeah, it was an experience for sure.
That's amazing. Do you have any tips for starting a business with a friend or family member, right? Because that can go two ways, right? People either get along really well and they see eye to eye, or they get in huge fights, right? I mean, I guess what are some of the tips you could offer for somebody who is thinking about starting a business with a friend or a relative?
Sure. And I've either started or helped found 8 different companies. So I'm definitely like pretty well versed on the entrepreneurial side of things. And most of them have been with partners. And some of the things I've learned over the years is like a partnership is really like a marriage. And I think you should look at it from that level of seriousness, right? Because it can be an amazing experience, or it can be like very, very painful and a big lessons learned if it kind of goes sideways. So you really got to look at it pretty seriously. You'd want to look at it in terms of a partner is someone who's not just like you, but more complementary, right? So you don't want to work with someone who's the same as you, because that could be problematic, and it's also not very conducive to growing a business. But if you have someone who's complementary to you, meaning they have a different skill set and you guys can kind of stay in your lane and they focus on this, you focus on that, I think that really can help set you up for success. And similar to a marriage, like you got to have good communications, right? You got to talk with the person regularly. You need to get along with them because you're going to be spending probably more time with them than you would with your husband or wife. So there's a lot of similarities there, and it's definitely not something to take lightly. But if you do it right and you put the right amount of energy into it, you can create amazing things, right? There's some really amazing partnerships out there that you would never be able to create by yourself, what you could do in a partnership.
And Chad, how did you discover real estate?
So interesting enough, like I was always in construction, right? Like in high school, I was in construction, working on different construction projects. I actually, for 2 years, worked for a really large construction management company during college, called Swinnerton Builders. Learned a lot there. Wound up getting my contractor's license, my general contractor's license, and then right when I started the lighting business, in the beginning we were like really busy, like 4 months of the year, 5 months of the year, and the rest of the year was really slow. And in that off season, I would be doing structural engineering consulting for custom homes, commercial buildings. So I was like always in the construction, real estate side of the business. I did that for several years. And then eventually the lighting business grew so big, I couldn't do the structural engineering consulting anymore, but I had a lot of experience. So that kind of went dormant, if you will, for maybe about 10 years before I exited the lighting business. And I like to say went back into real estate. And really the motivation for that was I'd met so many successful people that had a good size part of their portfolio that they built from real estate, right? I just knew a lot of successful people that made money in real estate. So I knew I always wanted to get back into it. And finally, when I was exiting the business, that was an opportunity to do just that. And so I started out, I bought 2 properties on my own. And then basically I syndicated a deal. We can talk about what syndication is, but I syndicated a deal, and that was my first deal that I did back in 2019. And since then I've grown my portfolio to be $150 million under management, and mostly in the self-storage and multifamily space.
Amazing. Very briefly, on those first 2 properties you bought, were they single family? Were they multifamily? What were they?
It was a single family home, and actually a medical building that my grandpa had built in 1952. My dad bought it from him in 1986, and I bought it from my dad in 2015 and still own it today.
That's wild. And both of those are in the LA area, correct?
Yes.
And so tell us, because it's a big step to go from saying, look, I own a few buildings to I'm running my own syndication deal. Maybe walk us through just at a high level, what does it mean when people say I'm running a syndication deal or I'm a general partner?
Yeah, so basically, a syndication is a group of investors that buy a building, and this, syndication can be done for various different things, but we'll talk about what it's done for in real estate. And so, yeah, basically get a bunch of different investors, pool their money together, and buy a large asset that they wouldn't normally want to or able to buy on their own individually. So that's a syndication. A syndicator or the general partner, that's basically like the quarterback of the deal. And for my first syndication, I was the only syndicator, the only general partner, which is pretty rare. But basically, so I did everything from A to Z, right? I would work with the real estate brokers to find a deal. I'd work with the loan brokers to get the debt on the deal. I'd raise money from investors. I would do all the due diligence on the property, secure the property, buy it, hire the property management companies, hire the general contractors, fix it up, and hold on to it for passive income for me and the investors, and then sell at some point. So that's kind of like the whole process of what a syndicator would manage, or the general partner of the deal.
And Chad, how did you build your network? I always find that that's one of the most challenging bits when somebody's starting out in the syndication space, finding the network, finding the high net worth individuals who have the money to invest. How did you build that?
So it's a lot like borrowing money, right? The wrong time to borrow money is when you actually need it, right? So you need to borrow money when you don't need it, because that's when it's a lot easier to get. Like when you're really in a jam and you need money, the bank and your friends or whoever, they're going to say nuh-uh, because they kind of smell blood in the water. The same is true for like syndication or networking. Like you need to build your network before you actually need it, right? So for me, I joined actually 10 years ago a group called the Entrepreneurs Organization. And that's a global group of over 17,000 business owners that are running $1 million and above per year businesses. And so I joined that group. That was a great network just to learn how to grow a business. That I used that kind of group to help learn how to scale mobile illumination a lot better. That was the name of the lighting company. And so just kind of building that network. But I mean, look, before I did my first syndication, I had 25 years of work experience, right? I didn't start at a very young age. So I had my network. And I'll tell you what's interesting about real estate is you don't have to have been in real estate forever, because you just have to be like a hard worker, grit, high integrity, and you can learn a lot of those skills and kind of prove out a lot of those skills in different industries. And then when you're doing something else, people like, oh yeah, this guy crushed it doing this and he did well there. And yeah, he's going to translate those kind of skills and talents into this. And this is a guy that I trust and I believe in. I know, like, and trust him. And yeah, I'm ready to invest. So it can happen. It can happen fairly easily, but you can't do it on day one. It's got to be something you build up over time.
And I like how you connected the 2 or 3 different businesses, right? Because it might seem to an outsider that a lighting business has very little to do with the real estate business, but it sounds like they are connected, right? In that the connections you made in your lighting business and in your other entrepreneurial ventures like construction management, et cetera. It sounds like the connections you made in those businesses helped you build your network for the real estate investment.
Yeah, and I'll give you a quick example of that. Like you talk about having some experience in going through down cycles, which is pretty important, and here we are, we're recording this in March of 2023 during some dicey times right now. But like in 2000, when the stock market crashed, like I was very much invested in the stock market, and I had to kind of learn how to evaluate risk and do reinvestments. In 08, 09, I was running a business and trying to navigate a business through the great financial crisis. Like I learned a lot during those times, and I've got some scars and war wounds to prove it. So now when we're coming in, to another cycle, or arguably into another cycle, like I've got experience that I can go back on, like, okay, how did I mitigate risk back then? How did I navigate those uncertain waters? And I use those same skills I learned back then, at least through those two cycles, to today's cycle, and I apply that to this business. So I think if you're always like learning and educating yourself during some of these tough times, that can be very helpful during future tough times.
Chad, take us through your first multifamily syndication deal. How many units was it? How big was it? And how did you grow from there?
So I'll share that story. It's pretty unique, and I'm not sure that I would recommend this approach for other people, but I'll share you what it was. So it was a syndication deal. It was a $2 million building I bought in Long Beach, which was about an hour and a half away from where I live, and I raised $1.2 million for it. But this was in 2019 when the market was really hot, and things were going really quick. So, and I was a solo guy doing this deal, which is also pretty rare and frankly probably not recommended for most people. But I got a deal under contract I found from my broker, and I literally only had like 12 days to do my due diligence. And then after that 12-day period, there was no other contingencies, and contingencies are basically like reasons that you could get out of the contract, right? So like I had no appraisal contingency, I had no financing contingency. I had 12 days, and after the 12 days, my down payment was going to become hard, which means non-refundable. I had probably about $100,000 of my own money on that down payment, and I had to decide really quick if I was going to move forward on this. I didn't have the loan yet, I didn't raise the money yet. And I had $100,000 that was non-refundable after 10 days or 12 days. So I wound up moving forward with it. I had probably a 60-day or so escrow, and I was hustling, man. I had been letting people know what I was doing ahead of time. I'd shown them sample deals, and I was kind of like nurturing that network for quite some time. So I didn't hit it cold turkey, but it was also my first deal, and I had never raised any money, right? The other two properties I bought was just on my own. So finally, I'm getting towards the finish line. I did pretty good on the money raise. At some point I had enough money to close, which was great. That was like a big checkbox to check. But I hadn't raised like the $500,000 or so that I needed for the construction budget yet, which wasn't dire, but I still needed to keep raising. I didn't have approval for the loan yet, and the due diligence process that they put you through on that is a nightmare. Like with the underwriting team, it's worse today, but it was still pretty bad back then. And then finally, like literally the week of the close, I'm like, oh my gosh, I still hadn't raised all the money yet. I need like another $100,000 to raise. And I didn't get approval on the loan yet the week of close. And I'm like, I was really, really nervous. And then literally like 3 days before we were closed, I got the final approval on the loan. I got the last $100,000 raise. And I finally was able to like sit back in my chair and like, oh my gosh, it was a huge lift, a huge weight off my shoulders. And we closed, and then I started a $500,000 construction project on it, remodeled it, fixed it all up, and increased the rents, or brought the rents up to market. Finished construction ahead of schedule, but on budget. I was about 2 months ahead of schedule, and still have the property today, and it cash flows every month for all the investors.
Nice. And right now, Chad, I took a look at your website. It looks like you are investing more in the Southeast, right? In Carolinas and Florida. Why the shift from California to the East Coast?
Yeah, so I made a very deliberate shift partway through COVID to start investing outside of California. there's a lot of very difficult rules to deal with in California. I mean, like we still have an eviction moratorium today for the city of LA. It's nuts. So became very difficult to collect rents from tenants. You didn't know what kind of new rules were going to be coming down the pipes, and
sorry,
underwriting is like
Chad, sorry to interrupt, but for our listeners, maybe just walk us through what does the moratorium look like in California for anybody who's thinking about investing in multifamily in California.
Well, you got to have thick skin and deep pockets if you're going to be investing in California. I'll say that much. But basically, in a nutshell, if a tenant would make a verbal statement, they don't even need to prove it, but if they can just make a statement that they've had financial hardship due to COVID, then if they don't pay their rent because of a hardship due to COVID, you can't evict them. And so they just don't pay rent. You can't evict them. They stay in your unit rent free for however long, years on end. And that becomes very difficult. Meanwhile, your mortgage still has to be paid. Your property taxes still have to be paid. Your maintenance costs are skyrocketing because of inflation. Your other operational costs are skyrocketing. Your rehab costs are going up. Like all your other costs are going up. And in some cases, you're just not collecting any rent. It puts landlords in a very, very difficult spot. So I made a shift with my investors to start investing outside of California in more landlord-friendly states, in other states that are growing a lot. And for me, most of that work has been in Florida, and Florida has been doing really well for us.
And Chad, what is your sweet spot? Like what kind of apartments do you typically look for?
Yeah, so good question. So typically we would look for it's called a Class C property. So it would be an older property, preferably with some deferred maintenance, meaning they're not really taking care of it. It's really beat up, run down. And so we come in with investors to fix it up, bring it up to like today's type of, not code, but today's how you'd like to live in a place today. And it's what we call moving a property from Class C to Class B. It's just improving the property, making it look really nice. And for that, renters are willing to pay a fair amount more money because they want to live in a nicer place. So when you do that, then you can increase the net operating income for the property. And that's what commercial properties are based on. That's what the purchase price or the sale price is based on, that net operating income. And if you can raise that up, then the value of building can increase significantly. But you also have cash flow along the way. So those are the main ways that investors can make money through this type of investment.
And Chad, when did you start getting into storage units?
So I actually invested passively in storage units probably in like 2020, and self-storage. And we talked about the general partner earlier. So the general partner runs it, but the limited partners, those are the investors. And I've done both. I've been a general partner and I've been a limited partner. And I think you've probably been a limited partner as well in a syndication. And I mean, that's like the holy grail. Like if you can have enough money to invest passively, then that's amazing, because you don't have to do any of the work and you get the cash flow that's coming from the properties, and it creates another passive income stream, right? We've all heard about the amazing things with passive income, and that's what syndication can do for you. So I started out investing passively in self-storage, and now I'm doing active deals in that space.
Very nice. And Chad, right now, what kind of returns are you targeting, for example, for your multifamily deals in Florida and the Carolinas?
So generally, we target like a 6 to 8% annualized return on the cash flow. So if you invest $100,000, you could expect to get about six to $8,000 a year on the passive. It's all passive, but passive income. And then when you sell it, generally about 5 years is the hold period. That can shift one way or another by a year or two. And when you sell it, if you include the cash flow and the pop at the end, you should be able to double your money in about 5 years. So that $100,000 would become about $200,000 within 5 years or so. That would be about a 15% or so annualized return, and that's pretty typical.
Nice. Yeah, that's excellent. That's what I'm hearing from a lot of real estate investors, right? Is once you get into the real estate game, you can usually work your money to get a 15% return. And I think that I hear that from quite a lot of investors. I think that's excellent. Chad, tell us a little bit more about CSQ Properties and about what people can learn from visiting your website.
Yeah, so CSQ Properties, that's what we do is syndications. We're in several different states. I still operate the properties I have in California, but I'm not actively acquiring right now. And by the way, those properties are cash flowing, so we're still doing well. But I'm not buying now because I'm too nervous about the legislative risk that we have in California right now. So that's what CSQ Property does. We work with investors of all types, generally high net worth, high W-2 income earners, entrepreneurs. For me, as a lifelong entrepreneur, as we've talked about, that's kind of like my affinity group. And so I really focus on trying to help entrepreneurs. I wish, like when I was an entrepreneur, I would have known about this a little bit more so I could have invested passively, because once I sold my business, I didn't have any other income coming in, right? That was my business. So I had to start something new. And so I wrote a book called Why Entrepreneurs Should Invest in Apartment Buildings. And it kind of goes through the downside or shortfalls that entrepreneurs have. It's really good in one hand, but on the other hand, there's some negatives to it or some challenges that are unique to entrepreneurs. So I'm trying to educate entrepreneurs on that. They can download a copy of that ebook from my website, csqproperties.com, and then also on all social media sites, just at CSQ Properties.
Thanks, Chad. And I'll put that link in the show notes. And again, that ebook is free if you visit csqproperties.com, and we'll put a link to that into the show notes. Chad, just what is your current outlook on the market? I know we're in a very precarious time. We have banks that are really struggling right now. And, for the record, right now, this is March 18th, 2023 that you and I are talking, but we have all kinds of banks right now that are stressed. We had a couple of banks that failed. Of course, one here, Silicon Valley Bank here in the Bay Area where I live, Signature Bank more, I think, on the East Coast. But how does that impact the real estate world? And what is your outlook on real estate in general, say over the next 6 to 12 months?
Yeah, it's a great question, and it's a very unique time right now. I'll preface it by saying that I think there's money to be made in all markets. And if you talk to, some of the best investors out there, whether it's real estate or anything else, there really is money to be made in all markets. Sometimes you need to change your strategy. Sometimes you need to be a little bit more careful or cautious. But I'm a firm believer of that thought. So speaking back to real estate, in today's world, I think one of the biggest things you need to be careful of is the debt. You really, really got to make sure your debt is really dialed in. And especially because we don't really know where interest rates are going to go. If you would have asked me this question 2 weeks ago, I would have said, hey, I think the Fed is going to increase interest rates probably 2 more times, plateau, and then come back down towards the end of the year. Right now, with Silicon Valley Bank collapsing, I think that is up in the air right now. So I think they're going to scale back their increase. My guess is going to be 0 or maybe 25 basis points on the increase, but they're really trying to throttle this back between inflation and interest rates. And the Fed and the economy, for that matter, is in a very, very precarious situation right now. 6 to 12 months. I think there's still real estate is still a great play. I would focus a lot more on really ensuring that, one, the debt is the right debt, that you've got that covered as far as an increase if that does happen, but also to buy cash flowing properties, right? And you want to have some debt coverage ratio in there that's going to cover you in case something goes wrong. And if you're still cash flowing, then that could be really helpful. And this is one of the reasons why I love commercial property. So if you look back in 2008, at the peak of the financial crisis, there was about 4% of all single family homes were in default, meaning behind on payments, going into foreclosure, 4%. In the commercial space, only 0.4% of commercial properties went into foreclosure. So 10 times as safe, if you will, if you look at that metric. Part of the reason for that is because the banks require that you have cash flow margin above what the debt service payment is. Right now, they require about 25% more. So you need to be having at least 25% more than the debt payment is what the property is earning or creating. And that 25% creates margin. So let's say you run into problems, like you got to eat through all that 25% before you can't make that mortgage payment anymore. So just by the nature of the way the funding and underwriting is done for these properties, you have a built-in margin. And if you couple that with our inventory issues, where we don't have enough housing for people, that bodes very well for multifamily pricing and investments. And also, if people can't afford their single-family homes because the interest rates are so high, then they're going to be forced to rent. So I think multifamily is a great space to be in for the next 6 to 12 months.
That's excellent. Yeah. And I'm glad you mentioned that. I haven't heard that one particular stat before about the percentage of multifamily commercial space that was behind, their payments versus single family. It sounds like it's 10 times, safer on average. That's a huge difference, right?
Yeah.
I saw a study recently where it compared like the 20-year returns on multifamily versus other types of investments, like stocks, S&P 500, gold, et cetera. And they said that multifamily commercial space had the highest return to risk ratio out of any other type of investment, right? Which also, is in line with what you said, that long term, it seems to be an excellent investment vehicle. And Chad, are you taking on any investors currently? And do you have to be an accredited investor to invest with CSQ Properties?
So yes, we're still taking on investors. And the answer to your second question, it depends on the project. So some deals you have to be an accredited investor, which generally means you make at least $200,000 a year, single, or $300,000 a year if you're married filing jointly, or you have at least $1 million in net worth outside of your primary residence. That is generally the qualification for an accredited investor. So some projects require you to be accredited investors, and some projects you can be an accredited investor, or you can be what's called a sophisticated investor, which means you have experience with investments and you also have a pre-existing relationship with the syndicator. So if someone is thinking about getting interested in these and they're not accredited, it really behooves you to get to know that person first, whether it's CSQ Properties or somebody else. Develop that relationship so that when they do have that type of deal that comes up, it's regulated by the SEC. In that example, it's a 506B regulation investment. Then if you have that pre-existing relationship, you're able to invest as a sophisticated investor and you don't have to be accredited.
Chad, thanks very much for your time today. I really enjoyed speaking with you, and best of luck on your projects in the Southeast.
Sounds good. Thanks, Gabe. Appreciate it.
Have a great day.